Great. All right. Well, good morning, everyone. I can see that there are participants filing in. So whilst we are waiting for that to happen, we'll just wait a few moments until I know we had over 100 registered for today's webinar. So we'll just wait for the majority of those people to pile in before we get started. Looks like it's slowing down a little bit there. So, all right, I'll use that opportunity to get going. So, good afternoon, everyone, and welcome along to the latest in our Buying Power webinar series. LGCs, crucial to credibility or holding us back. I have to admit that that was my slightly tongue-in-cheek suggestion for a name to this webinar, which is really just a discussion and an opportunity for us to take a look at LGCs and interrogate the mechanism a little bit, I guess, in order to bring to light some ideas and thoughts about the role that LGCs are playing in renewable energy procurement here in Australia right now, including what the future holds for LGCs now that the renewable energy target has been met, and of course what the beyond 2030 situation looks like once the scheme comes to an end. So my name is Pip Harley. I am a Program Director here at the Business Renewable Centre, and I'm joining you today from beautiful Mirrabera, otherwise known as Maroubra, in the eastern suburbs of Sydney. And I'd like to acknowledge the Gadigal and Bidjigal peoples as the traditional custodians of this place. And on behalf of the Business Renewable Centre, pay my respects to their elders, past, present and emerging. So Bujari Gamarua, which means good day in the Kuri language. I know that our speakers and many of our attendees joining us today are doing so from different locations from all across Australia. And so I invite and encourage you to acknowledge the traditional owners of the place that you're joining us from using the chat function. While you're doing that, and just before I introduce our panelists today and get into the conversation, a quick word about who we are and what we do. So the Business Renewable Centre is a centralised hub and membership platform for buyers, developers and service providers who are all working together to support the clean energy transition that is happening in Australia right now. So we are a collaborative partnership between Climate Kick Australia, WWF Australia, the Institute for Sustainable Futures out of University of Technology Sydney, and also we work in partnership with the Rocky Mountain Institute in the United States. We are funded by ARENA, the Victorian State Government, the New South Wales State Government, and also Queensland State Government. So pursuing large-scale renewable energy requires clear goals and a plan to reach them. So our buyer's roadmap outlines the steps for large-scale PPA procurement transactions. Our primers and guides that we offer to our members go beyond definitions of, I guess, the complex concepts that can come about with PPAs, and actually provide solutions on how to overcome barriers, and are developed by buyers for buyers. We also offer unique buyer bootcamp training days that help bring informed buyers to the market, and our events and our state of the market reports that we do each year bring thought leadership on emerging topics and also trends on what is happening in corporate PPAs to light. And our online marketplace acts as a connection point for developers, buyers, service providers such as energy consultants, lawyers, and so on that specialise in corporate PPAs to come together so that deals can happen faster and more simply. Essentially, we're an independent place for all of these players to be able to come together in order to unlock the marketplace for energy consumers to lead the transition to what is going to be a zero carbon energy future for Australia. Okay, so on to today's topic and an introduction to our panel. So joining us today, we have Jonathan Prendergast, who is one of the technical directors here at the Business Renewable Centre Australia. Lisa Zembrot, Director of Operations Energy Markets at Schneider Electric, and also Rick Brazzali, who is the Managing Director at Green Energy Markets. So thank you very much, all of you, for joining us today. It's a pleasure to have you all here. So, as you all know, one of the things that we do here at the BRC-A is to track all the PPAs that are signed in Australia, so as to be able to monitor the market and identify trends in how organisations are procuring renewable energy. And as we pointed out in our 2020 State of the Market report, what we're beginning to see is a real split in the marketplace between large energy users who are still signing contract for difference PPAs directly with renewable energy projects, and then smaller players who are opting for retail PPAs that have slightly less buyer-side risk. And we're also seeing sustainability come through as a really strong driver for corporate action in this space. So in order to kick off the conversation, and with that sustainability driver in mind, and sort of really recognising a lot of the organisations that are joining us on this call today's desire to be able to make credible environmental and climate-related claims associated with their PPA in the context of those kind of diverging or different products that are now available to them. I wanted to start with a wee bit of I guess, a meta question, which is to hear your views on how organisations can really deliver the greatest impact through a PPA. So Jonathan, I know that you had prepared some thoughts on this. I might just start with you, and then we'll throw to you, Lisa and Rick, to hear your contributions as well.
Well, I'll just answer verbally first. Great intro, Pip, and it's great to have this discussion. It's not just about our usual sort of market analysis and advice on how to do corporate PPAs, but this bigger picture on the future of this policy in Australia and what it means to our corporate buyer members and also our developer members as well. Certainly for 10 years, supporting new wind and solar projects was very impactful as we got to 5, 10, 15, 20% renewable. But now wind and solar are becoming part of our sort of core supply of electricity in Australia. And a part of that is providing all those other services that historic generation has provided, such as meeting demand and frequency control and being dispatched by AEMO. So as we move to 25, 30, 35% renewable, we'll need to do more than just build wind and solar farms. And that will include storage and dispatchable renewable energy. So in terms of corporate PPAs to maximise your impact, it's certainly great to see some buyers evolving in their PPA purchasing and starting to think firstly about how they can be flexible with their demand to adjust their demand via demand response or load shifting to suit the renewable energies in the system. And secondly, starting to think about battery storage. So we recently saw the New South Wales whole of government contract with Shell Energy result in the finance of a new 100 megawatt battery in New South Wales. So it's a good example of that starting to happen. Over to Lisa next.
Yeah, I would just actually like to underline Jonathan's comment around the demand side as being crucial to improving or increasing the impact of having a PPA. Is really the next step in this journey is ensuring that you're aiming towards, as much as you can, 100% real-time renewable consumption. So not just averaging over a year and covering 100% renewables, but really thinking about how can you use differently, or less, of course, in order to achieve consuming when renewable energy is available and plentiful. Just wanted to underline that.
Yeah, great. And I'm definitely going to come back to that topic a little bit later on in the discussion. So thanks for raising that point. Rick? Oh, you're just on mute there, Rick.
Sorry.
That's all right.
No, just concur with that, and it's really interesting to see a number of the large-scale pump storage projects being implemented as well. And I think, but eventually we'll come back to the point about it is, what are you really trying to achieve? Are you trying to reduce Australia's greenhouse gas emissions, or what sort of environmental claims does the business want to make? And then that will actually guide your strategy.
Yeah, that's right. And that why an organisation is coming to a PPA is a really central element of what we cover in our buyer boot camps, because it's all very well to, go dive straight into looking at the type of deal you might do and getting caught up in all the vernacular and the acronyms that come with any of these specialised topics. But I think really getting to the crux of why your organisation is doing this is a really important part. Okay, so with that in mind, what is the role of LGCs now that the RET has been achieved? So before, LGCs was a way of, or retiring LGCs rather, was a way of ensuring that renewable energy purchases were additional to the mandatory purchases of retailers. But now, and the idea, Jonathan, you talk about this a lot, that a buyer that supports a new project but doesn't retire LGCs potentially has more impact than a buyer who's retiring LGCs from an operating project. So what is the role of LGCs now?
Yeah, I think it's firstly important to touch upon what LGCs are, and they're really a tool. And they're set up as a market-based mechanism, which is what we heard a lot of in emissions trading policy times. And that is sort of a tradable certificate. So it's similar with other commodities, and maybe I'll refer to electricity commodity market first. So electricity, the primary market we have is the NEM pool price, which is currently settled at every 30 minutes, and in the future, in October, every 5 minutes. But the truth is, not much of the trading is really directly via that primary market. There's all these secondary markets around electricity, and they're things like baseload futures, caps contracts, and long-term PPAs. So no one's really, on the bottom line, paying those 30-minute high and low pool prices so much. Everyone's done secondary contracts around that to manage their risk. And that's been done similarly with LGCs. So the day-to-day spot price of LGCs or over time, same with the wholesale price, does drive pricing, but generally LGCs can be used as a tool. So one of them was the mandatory renewable energy target, which was 20% by 2020, which required liable entities like electricity retailers to buy a certain amount and retire them to meet their renewable energy target goals. So another way they can be used, LGCs, is through long-term LGC PPAs. And this has been done by the Solar Trams project in Victoria, and also the New South Wales government for meeting its 20% with some solar farms in Dubbo. And also green power is another system where it's an additional level of accreditation for various percentages of renewables. And that's done more on that sort of day-to-day or annual pricing. In terms of its importance beyond the RET, certainly it can be used as a long-term contract to support new projects, but retiring LGCs annually will bump up the price currently, but it doesn't provide the strong market signal that new wind and solar needs to get finance. A high LGC price today doesn't mean wind and solar will get financed, because it takes 2 years to build the things and they're 25-year assets. So a high price today really doesn't underpin new investment, unlike a PPA, where if a corporate goes to a wind or solar farm and signs a PPA with them, that is a contract demanding that they build and operate that power plant, or else there's penalties or liquidated damages and so on. So in those terms, I would suggest that a PPA that pre-finance for a wind and solar farm that helps it achieve finance and get built and reduce emissions through that generation, it can be more impactful than just LGC retirement.
Lisa or Rick?
Oh no, absolutely agree. We've seen the level of new project commitments, renewable project commitments, start to drop quite dramatically as we're seeing wholesale prices fall. So new renewable projects do need some form of contracting support. So it's imperative for new projects.
Yeah, that was what I'd like to highlight as well, is that the role of LGCs, the question you asked about, what impact, what role do LGCs have? The role is to still now help renewable projects get financed. And that is just one part of the role of the LGC. The LGC is, of course, as we'll talk more about, I'm sure, how a corporate can prove that they're buying. It's the credibility of buying, renewable energy. So it has more than one role, but certainly a very important one in the fact that it is crucial to financing for new renewable projects, which we absolutely need in order to continue the renewable transition.
And what do you think about this idea that just focusing on this impact concept for a moment? What do you think about the notion that the retiree, that support buying power from a new project, but not retiring the LGCs is as impactful or more impactful than one that where LGCs are being retired from an existing project?
Covering on the topic of additionality, as Rick touched on, corporates need to think about what's the aim that they're looking to achieve, and if it is to actually help improve or increase renewable generation or renewable capacity in the market, then buying LGCs from projects that already exist will not achieve that. So if you are looking for additionality, the only way to achieve additionality through a PPA is to ensure that it's obviously with a new project.
And so, that generally tends to, I guess, be most available to large energy users who can be signing these contracts for different type PPAs, right? And going direct with an energy project. What about smaller organisations that want to have a similar impact in that vein?
I think in that case, it can be, so we certainly see a very common model of smaller buyers sign up with retailers in sort of renewable energy retail agreements, or retail PPAs as we call them for short. And those contracts sort of see similar electricity bills, peak, shoulder and off peak, maybe 7 to 10 years. And are much more familiar for that organisation and more aligned with the capability of their renewable energy procurement. Plus it avoids complexity around contracts for difference or other similar direct contracts with wind and solar projects. And those sorts of deals can be classified as additional if it's with a provider that is known to be very active in investing in or contracting with new wind and solar. And your PPA is likely to see more of that occur in the future. I think it's a good grounds to claim for additionality in those cases.
Yeah, great. So we've touched on this a little bit already, and I think you mentioned a couple of them, Jonathan, but we've seen a few LGC-only corporate PPA deals emerge in recent times. So could you just give us a brief overview for people who may not know how that type of deal works and what you think the drivers behind organisations taking that approach are?
Yeah, they're certainly less common. So solar trams and New South Wales government, and also Coles supermarkets, they signed PPAs with 3 new solar farms in New South Wales for their New South Wales demand. Then they went to Queensland and signed up with CleanCo. And CleanCo, I would classify in that sort of previous comment as they're a renewable energy only company, apart from maybe a gas or a diesel peaker. They've got Wivenhoe pumped hydro and a couple of other hydro projects, and also have signed 3 large-scale PPAs, one with a huge 1 gigawatt wind farm in Queensland, 400 megawatt solar farm, and another project as well. Coles signed up with CleanCo for Queensland. When they moved to Victoria, they signed an LGC PPA with Dundonell wind farm. And that is a now operating wind farm, so it wasn't pre-finance, but it's owned by Tilt, who are pretty much only a renewable energy developer and investor. So their objective there maybe was that they could, they're making 100% renewable energy commitments. And if they buy from the spot market over time, there is a risk to them that that price could go up in the future. So they wouldn't want to leave that risk unmanaged. And by signing a LGC PPA with Tilt and Dundonell Wind Farm, they get to lock in that price for the next 10 years and can take that risk off their balance sheet. And by securing that PPA by Tilt, that kind of unlocks more capital for them, because they've got this creditworthy off-taker and this certainty of revenue, so they can reinvest that unlocked capital into their subsequent projects.
Do either you, Lisa or Rhett, do you have any thoughts on this LGC only corporate PPA? Are those kind of deals appropriate for all types of organisations, or are they best suited particular size or types of organisations, or it's more linked to what your objectives are?
If I might start first, I think it really depends on what your objective is. If it's merely an accounting exercise to make claims that you're 100% renewables, then that works, that fits that. But if you wanted to actually, make sort of be more impactful, which would be to support new renewable projects, then you should support a new renewable project. Or if you wanted to be more impactful still, you should surrender carbon units. But that maybe we'll get onto that later.
I think maybe I'd add that I'd commend the companies who are buying LGCs, even post-finance, to be 100% powered by renewables. I think that's showing a commitment and driving forward the progress that we need. So even if it's not achieving additionality in the moment, I think it's a commendable action with more, I'm sure, ambitious things to come from many of the companies in Australia.
So can I just play devil's advocate for a moment on this one? Because I guess I've heard there's an argument that we hear around this topic, I guess, that by taking this approach, organisations are still sending demand signals to the fossil fuel industry via their normal contract, and that LGCs are a weak signal that don't necessarily support new generation now. So even though they're buying LGCs in order to be able to make credible environmental claims, going on this impact approach, does this having LGCs in the mix effectively sort of slow us down in terms of this transition away from fossil fuel energy? What are your thoughts on that?
Maybe I'll start. I'm not of the view that buying LGCs today to meet renewable commitments that a corporate might have, for 2022 or whatever, is slowing us down. I think these are things that corporates are making commitments to buying renewables to meet, for example, RE100 targets. And that's the first step of many of these company strategies. In fact, if you dig into the sustainability strategies of many of the corporates or universities or other large organizations in Australia, you'd find that buying renewable energy is just the first step of their full sustainability strategy and decarbonization strategy. So in my opinion, it's not slowing us down. I think it's I think it's the first step in many actions that are planned for many of the companies that at least I'm aware of.
I would concur with that. I did ask the Sunshine Coast Council team what happens when they built a 17 megawatt solar farm in their local government area, which is the equivalent of how much energy they use across the year. I said, what happens to the sustainability team there after you do such a thing where you achieve such a great outcome? Do you all have to find other jobs or what happens? And they said, no, their sustainability team has grown and they're doing all the next level things. So reducing other sort of scope 1 emissions, looking at resilience and on-site solar and storage for some of their facilities so it could keep the power going through resilience and many other sustainability initiatives within their local government area.
Rick, any comments from you on the idea that still having a contract with a fossil fuel energy provider whilst buying LGCs is potentially not sending the right signals?
I think it doesn't take us, I don't think it takes us backwards. I think maybe there's more that can be done. And maybe it's a good point to sort of reflect on, we had this debate nearly 10 years ago with the previous Labor government. It was around green power and voluntary action. And the previous Labor government had committed to surrender an AAU, which is an annual allowance unit, which is essentially is surrender one of their permits that they would use to give recognition to voluntary action through green power. And they actually did that for the 2010 generation year. They did surrender some AAUs. And so I think we've actually got a policy failure here. So we just need to link up the voluntary action with a surrender of an annual allowance unit. And so I would argue that, no, we do want people to continue surrendering LGCs, but we need to work even harder to actually fix the policy problem we have, is to make sure that that voluntary action does lead to an annual allowance unit being removed.
And just to touch on that, so we have a sort of federal government or national emissions target by 2030, and there's a risk that sort of greening the electricity grid achieves that and stops action elsewhere. Is that the policy failure?
That then leads to that policy failure, yeah. Because our Australia's emission target is locked in, let's say, and so if a lot more voluntary action takes place in electricity, that means other sectors like other stationary energy sectors and transport, for example, we don't need to do anything there because electricity, it's all going to be done in electricity.
Yeah, and I think corporates are going to lead the way there, and eventually the Australian government will catch up, whether it's peer pressure or something else that drives it. But I completely agree with you, Rick. We have certainly a policy failure. There needs to be more ambitious targets from the Australian government so that we aren't in a situation where companies and other organizations addressing their scope 2 emissions doesn't do all the hard work for all of Australia. There's so much more work that needs to be done, and it can't be just limited to the electricity industry.
I think our electricity generation in Australia is very emissions intense compared to other countries with brown coal, particularly in Victoria, and then black coal in New South Wales and Queensland. So it certainly must remain a priority to decarbonise our electricity grid as quickly as possible. And I think for corporates, so from what you're saying, Rick, retirement of ACCUs are separate to that federal or national target, so would be purely additional, whereas reducing emissions in our electricity sector just helps us on the way to a predetermined target. And I guess what's driving corporates is if say scope 2 emissions, electricity usage are 80 or 90% of my emissions, that's what I should green. I shouldn't just buy dirty energy and offset elsewhere. So that would probably be the driver behind this renewable energy activity.
Yeah. Yes.
I should have said this at the beginning of the call to everyone on the line that we will definitely be opening up to questions, and please put them in the chat. But I think it's a good time to just go to the chat quickly, where we've had a question come through. I'm just going to sort of read it out rather than try and paraphrase it in real time. But Lolita has said that we're seeing an increasing number of clients securing LGCs through renewable PPAs, be it blended or LGCs only, as a way of offsetting electricity-based Scope 2 emissions through voluntary retirement to the Clean Energy Register. So as opposed to just trying to set their renewable energy target liability price for a longer term, this behaviour is critical in terms of taking LGCs out of the market, maintaining LGC pricing, and thus supporting new renewable investment. Based on a notable increase in this behaviour, we see LGCs increasingly playing a key role despite the RET target having been met. Thoughts?
I would agree. Just because the RET has been met doesn't make LGCs any less impactful or important. As we discussed earlier, it's a crucial part of getting renewable projects financing and proving that you've reduced your Scope 2 emissions, whether it's through additionality or buying LGCs from an existing project. And regardless of the specific impact that you're looking to make, it's still proof that you are supporting renewable energy through the purchase and retirement or surrender of those LGCs. So they absolutely have. Yeah, I agree.
I'd like to hear Rick on this one, because I think green energy markets do the numbers on how much the RET is in terms of LGCs and the corporate commitments around retiring LGCs and how that compares.
Yeah, if I can briefly just quickly go through a couple of numbers. So we've got the mandated target 33 million, and we've got current voluntary demand that we've tracked, which includes green power and a number of renewable PPAs as well as LGC purchase commitments, around 10 million LGCs equivalent, and that was at the end of March. So that's a combined sort of renewable target of 43 million. And currently, with projects that are already under construction, we anticipate that by 2024 we'll have 15 million per annum more LGCs than that. And with projects that have PPAs, there'll be another 15 million on top of that. So there's we're looking at a massive oversupply, and so we will need quite a significant increase in the voluntary demand for LGCs to really make a really meaningful impact on the price to bring more projects forward, we think. Now, that doesn't mean that voluntary action in itself won't support a higher price, and a higher price definitely will bring forward projects that may not otherwise have happened. But I think to be meaningful, we will need a significant increase in the LGC price from the forward price of $7 out in a few years' time.
So to recap, the RET was 33 million, and projects under construction are an extra 15, other projects that are contracted at another 15 million, so a 30 million oversupply, so almost doubling of the renewable energy target.
Yes.
And so for demand to meet that supply would be a lot of voluntary action by corporates.
Yes.
But I presume demand for LGC retirement is linked to price. It is. So if the price comes down from 3 years ago $80, $85, now it's $35. If it came down to $10, $5, that's likely to see more voluntary retirement in the future.
Well, we're seeing when you look out a couple of years, I think calendar 2025 price is $7. So the price is heading down that way, and you're absolutely right. It'll make sort of LGC retirement much more attractive, and essentially we see that voluntary demand like that will keep a lid under the price to some extent.
So we've had one of our attendees pop in the chat there that the price demand conversation is always circular. Explain.
As with any market, supply and demand depends on the price,
depends on the supply and demand.
Yeah.
Yeah. So I think what I would add is that at these lower prices, it won't just be corporates who are looking to purchase renewable energy through, you know, the purchase and surrender of LGCs, but also households as well through their retail agreements, you know, their household electricity retail agreements. And I think that we will continue to see that really strong demand for LGCs. LGCs, as I mentioned, are really the way of three ways, but the most common way for people to address or companies to address their scope 2 emissions, right? It's the market mechanism. The other two, of course, being DERs and energy efficiency things. But if you aren't buying that LGC, how will you prove in your marketing and other such things, or to your sustainability targets, or your stakeholders or your investors, that you are buying renewable energy? There's going to continue to be demand for the LGC as a result of that, as we need to decarbonize, we need to address the scope 2 emissions, and then move on, as Rick had said earlier, then move on to the other things where ACCUs and other carbon emissions reductions certificates or units can be used to address the scope 1 and scope 3 emissions.
So if I can just use that point in the conversation then to, I guess, just look at a slightly, I guess, new, kind of a bit of a nascent idea here in Australia, but a conversation that is already happening in the US with the likes of Google and so on, about the notion of reaching true zero emissions. And we touched on this at the beginning of the call, as opposed to net zero emissions, by focusing on matching time of day demand to time of day supply. So what do you think about the difference between net zero that matches generation and load over a year versus true zero that matches it in real time? And do you think organisations can reach 100% renewables in that world without LGCs?
I see a real positive there, where you look at your demand, and when you use power can change in its emissions intensity. So using it in the middle of the day, or when it's windy, for instance, if you can be flexible, could be 100% renewable based on that time of use. And then at other times, on a peaky cold evening, for instance, if it's still a lot of coal and gas, that you would have higher emissions intensity at that time, and starting to think about that. And a result of that could mean, if you're looking at an energy efficiency program for your organization, that you focus the energy efficiency spend on the times of high emissions, like the evening peak, for instance. I'm a bit, I see a risk with trying to match your demand with a single or a group of generators. I think generators are best operated sort of working to the market. So if demand is high, just say you had some solar and some wind and some pumped hydro in a portfolio. If demand is high, then you should certainly dispatch your pumped hydro to meet that demand, and if the price is high. If demand is low, but your own organisation's demand is high, I think that could be a wasteful use of such a valuable resource, and it's generally better to work to the market and to the greater energy system than trying to spend too much valuable capital on trying to match your load exactly all the time with a pool of assets.
I was going to say, there are some industries that will struggle to be, have zero emissions, and will need to be buying offsets as a result. But the industries that can move to zero emissions should look to do that through energy efficiency, changes in their processes, fuel switching, and the like. And it can be done, and we need to learn from those who pioneered to do it. That's part of where we are in this world, where it's innovative and things are moving quickly. We need pioneers like Google and others to tackle this, learn from it, and teach the rest of us how we can actually make it happen. Now, we know that there are fantastic software platforms like AutoGrid, for example, that can actually bring together, whether it's from a whole grid of renewable energy or from a specific asset on site that you're using, and using that automation software to match your supply and demand. So it can be done. There's some learning that needs to happen. but there is still a role of the offset in that group of industries that won't be able to easily decarbonize.
Yeah, great. Okay. I mean, I know that conversation has been coming through from a few people, and in fact, there's a point in the chat here about it from someone. It's kind of moving quite quickly, so there was something around. Someone's put here, can the panel comment on the potential for products like Enosi's Power Tracer for small energy users to support ongoing renewable energy development, often without an LGC bundled in, i.e. where small users are linked to larger generators? So that's kind of along those lines, right, Jonathan?
Yeah, I think, again, moderating your demand so it suits those sort of lower carbon generation times is good. I think the focus should be on how it supports continued investment in new wind and solar. If you become a customer of an existing wind or solar, it doesn't really have the ability to generate more power just because it's got another customer. So it doesn't reduce emissions more. But again, if you're for smaller buyers where it's less possible to contract with a 300 megawatt wind farm, certainly signing up with renewable energy developers and retailers that are investing in renewables is very impactful as well.
Yeah. Mindful of time here, I might just move us along to, I guess, the post-2030 discussion. What are your views on what's going to happen with LGCs then, and what organisations with, I guess, long-term goals, net zero 2050 and so on, can do to ensure certainty for grid-connected renewable power? But yeah, what's going to happen with the LGCs after 2030?
Probably the least expert out of the four of us, so I'll go first and you can correct me. But I think we had a 2% target under John Howard and 20% under that Labor policy, and they were renewable energy certificates, but then it got split between small technology and large scale certificates because it's not viable for a household to get 2 kilowatts and annually claim their renewable energy certificates. So small technology was created so they just get paid out up front up to 2030. So with that background, I would imagine that renewable energy certificates will always be a thing with or without the mandatory renewable energy target, the 2020 and 2030 plan. So there will be some form of renewable energy certificate post 2030. And also with PPAs, corporate PPAs, they're always drafted in a way that talks about green products. And that takes into account that it won't always be LGCs because that was set up in a particular way for the 2020 renewable energy target that goes to 2030. So there'll need to be work done post 2030 at a federal policy level. I guess that's a comment on LGCs, and why we're talking about it today is all policy needs to be updated and adapted over time due to changing markets, and it's really has been a set and forget and so far. And maybe that's what we're lamenting today, that it's sort of still the same policy from 2010 and hasn't been, and in that way has been quite resilient as a policy, but certainly there's time to reshape and adapt it for the changing energy system and changes in technology. But I would say, yes, there'll be RECs after 2030 in some shape or form. And Rick and Lisa, is that correct?
Well, I think the only, technically the mandatory obligation on retailers essentially finishes at 2030, but you're right, there's no reason why the framework couldn't continue on. And also, whilst we've got, whilst our electricity has reasonable amounts of carbon in it still, sort of renewable energy is an effective form of emission reduction anyway, and so should qualify under a methodology under the Emission Reduction Fund to create ACCU. So there's a perspective that we may see sort of LGCs and ACCUs form some sort of linkage, and then we may see over time sort of ACCUs replace LGCs or some sort of currency conversion, whatever you want to call it. Certainly the Grant King review of the ERF about a year or so ago did raise a number of these issues. And we have some renewable projects behind the meter sort of renewables are eligible to create ACCUs under the industrial fuel efficiency method anyway. So there is currently some interaction. So I'm thinking perhaps ACCUs may become a more important pathway in the future.
And is there enough supply of ACCUs or at the moment to meet sort of future demand, or will the price go up to the extent that everyone will start saying we need LGCs to be part of that mix to keep going?
Well, that's another more complicated issue about supply and demand of ACCUs. But certainly if we have international linkages, the expectation is that ACCUs will be linked internationally as well. So, and ACCUs will be a mechanism to meet any sort of tougher emission reduction target that we may have. So certainly the 26 to 28% reduction by 2030 is not sufficient by 2030, let alone 2040 or 2050. So we're going to have to drive emission reduction in some way, and ACCUs is a reasonable market-based mechanism to do that.
Lisa, did you have any comments on LGCs post 2030 that haven't already been said?
I generally agree with the gentleman.
Yeah.
Probably I might add that if I think about, again, coming back to what someone is trying to achieve, I think we might see in the future that ACCUs might become more important than international carbon reduction units, only because I would expect to see that the scrutiny, I suppose, would want to be more nationalized, a bit like how it works with scope 2 emissions today. So it will be interesting to see how ACCUs are generated and what the demand looks like in the future, but I suspect it would grow even from that direction.
Great. Okay. We actually had some questions come through from some of our members prior to today, and I'm just going to try and pick up on a couple of those before we wrap things up. So one of our members is saying that they've heard indirectly that customers are trying to insert post-2030 LGCs into PPAs. What has the panel heard about this, and how are the options being priced? Rick, maybe that's something you can comment on.
Oh, not really, actually.
Okay.
I'm not sure how you would price them, because there's sort of no mandated target, but that doesn't mean there's not a market for them.
Yeah.
There's still a value in them, right? So
yeah.
I think normally what you'd do is you'd come up with what is the fair value, and you'd look at some of the other alternatives to that, like ACCUs, for example, or CERs out of Europe, just to understand what's the value, since there is not great interchangeability, but there is some interchangeability between an LGC and other emissions reductions certificates or units, and that's one of the ways that you can value the LGCs beyond the end of the scheme itself.
Jonathan, anything from you there?
Yeah, I think a few years ago in the US, depending on the state, renewable energy certificates range from $2 to $3 to $30 to $50. So if renewable energy certificates are going to be part of your future claims, it's important to at least have some control of that, rather than a infinite potential cost in the future. So you might value them somewhere between $10 to $20 post 2030. Hopefully emissions reductions becomes cheaper over time, but it will also depend on the sort of legislated reductions, and if they take up a lot of the cheaper forms of emissions reductions, to get to the next 10% emissions reduction might become more expensive. So it's a market to watch, I would say, and hard to predict that far in the future.
Okay, we've got another question here from an attendee who said, we've seen PPA products that offer 120% voluntary LGCs to ensure that they satisfy all the carbon claims over and above the mandatory 20%. This sounds like a blue ribbon environmental product, to quote verbatim, to future-proof environmental claims of being 100% green. Is this necessary in your views, as it obviously costs more to add an extra 20% LGC to the product?
Yeah, so to clarify, this is 120% voluntary LGCs, not to offset non-Scope 2 emissions, but just to cover off the electricity emissions, as far as I can understand what Darren's asking there. And my understanding is that's not necessary. We did the environmental claims webinar last year. I think the video is on our website, so you should certainly check it out, with Bruce Precious, who talked about a market-based approach versus the typical sort of regional-based approach, in which case you assume that the first 20% is renewable, but you factor up the emissions intensity of your state grids to factor that the rest is not renewable. And then you do your emissions reduction from there. And in that case, you would need, I think it was 80% LGC surrender to achieve 100% renewable. But to get to the bottom of that, I wouldn't rely on my words. It's not my area of expertise, that sort of level of carbon accounting, and to refer to that webinar video.
Great. There's just a couple of others here that I'll just touch on quickly. It seems like only top 20 energy users in Australia are big enough to bank a new project. What is enough for the rest of us? Existing project achievable? No, I don't quite understand that last bit, but perhaps you do, Jonathan.
Yeah, well, Phil Bailey wrote earlier saying, oh, his group,
yes.
Climate Capital, do projects under 5 megawatts. So certainly that is an option for smaller buyers. And City of Adelaide did that. They signed up with Flow Power, which had a PPA with a wind farm, but it also, that particular retail contract saw the finance of 2 new 3 megawatt solar farms. So it shows it is possible at a smaller scale. But certainly, back to my earlier comments, if you are smaller and can't sign with a 300 megawatt wind farm, signing up with something like that Tilt Dundonell wind farm deal I referred to provides that renewable energy developer a release of capital that allows them to invest in more projects and can be claimed as additional.
Yeah, those retail PPAs, some of them can be changed, can have additionality claims attached to them. Probably something that we haven't touched on just yet as an option is when aggregation plays are in the market. Those are good ways for smaller companies to sign on. Now you have less negotiating power than you might on the T's and C's if you were very large, but it is still a way that you can achieve additionality by signing a PPA through that, some sort of an aggregation play.
Yeah, absolutely, and we're definitely seeing quite a few of those deals emerging. Vico just announced recently, and there's some hunter councils going through that at the moment as well. There's a question here. Oh, sorry.
I think Miriam's asked twice about the likelihood of the
yeah,
rep
I was
going
just
up,
about to go there. Yeah.
The first time she asked 50%, and now she's feeling more optimistic during this webinar, so she asked 100%. And it's really a political question, isn't it? Like, who would it would tie into the politics, and what we're seeing now is that politically in the current government, they haven't used the RET to ratchet up emissions targets. So in their place, state governments have stepped in and signed PPAs with a lot of wind and solar farms and supporting storage projects as well. Victoria is getting a big battery. South Australia's obvious one, and New South Wales doing a lot of work supporting battery storage and pumped hydro projects as well, and Queensland, of course, as well. So yes, as it stands, it could go either way. If there was a change in government, would they look to the RET or a similar scheme to achieve more emissions reductions in electricity? It is an option, and that's probably the basis of the discussion today, that it probably needs to be more nuanced than that, because we're moving to a new phase of the transition that just providing a sort of a target and LGCs is possibly not enough to keep decarbonising our grid.
If I can make an observation, we saw in the lead up to the last election, the ALP essentially come with a policy, a number of policies, but one of them was to ramp or increase the safeguard mechanism as a way to sort of meet, or part of the policies to meet their 45% emission reduction targets, and so that could still be an option for let's say the next government to use a safeguard mechanism as well as other policy levers.
Great. Okay, well, thank you, everyone. I'm going to have to bring things to a close there. We've come to time. But thank you very much, Lisa, Jonathan, and Rick, for your conversation and your thoughts today on this topic. For those of you whose questions we didn't get to, we'll take a note of those and make sure that we get back to you post the webinar. So in addition to thanking our panelists today, I'd also like to acknowledge and thank the generous support of our project partners, WWF Australia, Climate Kirk Australia, and the Institute of Sustainable Futures, our funding partners, ARENA, the Department of Planning, Industry and Environment in New South Wales, the Victorian Department of Environment, Land, Water and Planning and Sustainability, Victoria, and Trade and Investment, Queensland. Also our strategic members, Baker McKenzie, Energetics, Schneider Electric, Energy Estates and Precinct. Without the in-kind and financial support of all of these organisations, the scale of our work would not be possible. I just want to put a quick plug out to some work that the BRC-A has coming up. So we've got 3 new resources due for imminent release. One of those is about how to build internal support for getting your PPA up within your organisation. We've got another one that's going to be coming out about how to engage consultants as part of your process. And we're also looking at doing a bit of an industry discussion paper around what best practice PPA looks like. So please keep an eye out for that one. And finally, a plug for our upcoming Buyers Bootcamp. If you're on the start of this journey and you're looking to purchase renewable energy this year as part of your sustainability plans, please register an expression of interest. It's a 1.5-day workshop happening on the 28th and 29th of July here in Sydney, and we'll be doing another one in September in Melbourne. Also, if you are looking to procure renewable energy, please do become a member of the BRC-A. It's free for buyer organisations to join, and we're here to help you make that journey simpler and faster. So head over to businessrenewables.org.au to do that. Thank you once again, everyone, and look forward to speaking again soon.